So good morning. Our topic for today is inventory estimation. This is the final topic for inventory. Final topic for inventory. In learning inventory estimation, we must learn the limitations for inventory estimation, and also we must learn what are the purposes of inventory estimation. So let's start first with the limitations, or what is inventory estimation first? Inventory estimation is the process in estimating the amount of inventory to be placed in your expense and to be placed in your balance sheet. So what we do in your inventory estimation, we have here your total inventory. We estimate the amount to be placed in your income statement or statement of comprehensive income, that is as to our cost of goods sold, and the item to be placed in your balance sheet or statement of financial position. This is your ending inventory. So take note here, we estimate the amount of cost of goods sold and ending inventory. So this is only an estimated amount. This is only an estimated amount. Now, before we apply your inventory estimation, what we do is we need to learn about our our limitations for inventory estimation. So we need to learn the limitations of our inventory estimation. So what are the limitations? So the first limitation is it is only applicable for interim financial statements. For interim financial statements. So what is an interim financial statement again? An interim financial statement is a financial statement, not an annual statement. So any period of financial statement, not an annual financial statement, that is an interim financial statement. So why is it applicable only to interim financial statement? By the way, what is the standard for interim financial statement again? It is PAS 34, known as interim interim reporting, I think, or interim financial reporting. I don't know the title, nakalimutan ko na. PAS 34 interim reporting or interim financial reporting. Okay, so again, interim FS is used solely for statements not covering a 12-month period or an annual period. Now, why is it that it is only applicable to interim financial statement? It is only applicable for interim financial statement because PAS 2 provides that in the reporting inventory, it must be based on our actual value. It must be based on your actual value or net realizable value, not on the estimated amount. Therefore, we cannot apply inventory estimation for an annual financial reporting. We cannot apply your inventory estimation for annual financial reporting, but only for interim reporting. So take note of this. Soon, when you go and apply PAS 2 in your workplace, you must apply PAS 2 in annual, but you can report in your financial statements in the interim in an estimated amount. Why so? Because normally in getting the value of your inventory, it is too costly. Why is it costly? It takes too much time to count the amount of your inventory, especially if the company is with branches. You need to get for the total inventory of the different branches. And it takes too much time and it is costly. Now, however, to uh, to at least lessen the cost, we have here your inventory estimation. But take note, for annual, we use your actual inventory under PAS 2. Another limitation is it is useful only if you are using periodic inventory system. Using only periodic inventory system. Why? Because guys, if ever you are using perpetual inventory system, you do not need to, no need to estimate. No need to estimate. Why? Because under your perpetual, we keep records. We keep records. So no need to estimate the amount of your inventory. You can always check the amount of your inventory based on your record, and you will only adjust in case for the annual if there is any shortage or overage on your inventory. But since that is perpetual for interim reporting, let's say, you can you cannot make use of inventory estimation because again, you have available records. While for periodic inventory system, there is no available record. There is no available record. Why? What we have only here is the beginning inventory and the total purchases. So this will give us our total cost of goods available for sale. So we do not really know how much is our ending inventory and how much is our cost of goods sold. That's why inventory estimation is applicable to it. Okay, so it is only applicable to your periodic inventory system. We split the total cost of your goods available for sale to your ending inventory and cost of goods sold. Okay, another limitation is that the gross profit rates for the sale of inventory is stable throughout the period. So what we have here is a GPR. Okay. So our GPR must be stable throughout the period. It means there was no change on our GPR because again, we look as to the relationship of your sales, cost of goods sold, and gross profit. Now, if ever our gross profit changes, let's say increase or decrease, it means that we cannot really uh, look into our cost of goods sold as a portion of our gross profit. Why, guys? Because again, here we do not have a stable amount of gross profit rate. Then we cannot say that, for example, for your sales, to compute for your cost of goods sold, sales multiplied by 1 less GPR. Okay, so since your GPR is not really stable, it doesn't mean that your per peso of sale represents a portion of your cost ratio because we have a different amount now of your GPR as compared to a single portion of your GPR rate that is to be forecasted based on your sales to get for your cost of goods sold. That means that for every peso sale, you maintain a certain GPR. Unlike the other, if ever it is not stable, every peso sale, you don't know the GPR. Okay? So here, if ever there are changes in your GPR again, we cannot project it to your sales because we don't have any relationship as to sales and GPR. However, if ever your GPR is always constant, if your GPR is always constant, what we have here is again a projection to your sales to get for the amount of our sales and cost of goods sold. Okay, so ayan. So again, how do we compute for your cost of goods sold? That is sales times 1 less GPR. So what are the three limitations again? First, it is only applicable for interim financial statements. Second one, it is for periodic inventory system only, not used for perpetual because in perpetual, we keep records. While in your periodic inventory system, what we have in our records is the total cost of goods available for sale. So we need to split the amount of ending inventory and cost of goods sold. For number three, we have a gross profit rate that must be equal among the periods. Therefore, there must not be a change in your gross profit rate during the period because if ever there is a change, we cannot project it to your sales. There is no relationship of your sales to your gross profit, and at the same time, there is no relationship of your cost of goods sold to your sales. Therefore, you must always maintain the GPR. Okay. So these are the limitations. So what are the purposes of inventory estimation? So the purposes of your inventory estimation are: first, it is used to estimate the amount of cost of goods sold and ending inventory. Take note, this is the main purpose. From your total cost of goods available for sale, we need to split that as part of your cost of goods sold and as part of your ending inventory. Another purpose which evolved over time is to estimate the amount of loss on inventory. to estimate the amount of your loss on inventory. So what happened on that purpose? So after we compute for the total cost of goods available for sale, we have your costs and we have your ending inventory. So under your ending inventory, take note, this is only your ending inventory estimated. And at some point, you can only compute for the actual ending inventory. So there is a difference on your ending inventory estimated per your gross profit and your actual ending inventory. So since there is a difference on your actual and your estimated, we can say that that is a loss. That is a loss. Normally, you can see this in problems wherein you are asked to compute for the loss due to fire, due to earthquake, uh, stolen inventory, etc. So normally, questions relating to number two ask you about the loss due to fire, earthquake, and whatsoever circumstance that there is a loss on inventory. Again, the two purposes of our inventory estimation is first to estimate the amount of your cost of goods sold and ending inventory. Another is to estimate the amount of your loss on inventory. So how do we estimate the amount of our loss on inventory? We get for the ending inventory estimated and your actual ending inventory. So we compare the two items, and if there is a difference, we call that a loss. We call that a loss. So take note of these purposes because our inventory estimation will only revolve on these items. Our inventory estimation will only revolve on these two purposes. So later, you will learn that in our examples, you will always compute for what is the amount of cost of goods sold, what is the amount of our ending inventory. And also, if ever, questions is what is the amount of our loss? Okay, we go forward and learn about the two methods of estimating your inventory. So, two methods of inventory estimation. So what are these two methods? First, you have your gross profit method, and we have your retail inventory method. In your gross profit method, we get the relationship of your gross profit rate and we project that into your sales to get for your cost of goods sold. So ang gagawin muna natin, we get for a gross profit rate, we project that to your sales so that we compute for your cost of goods sold. After computing your cost of goods sold, what we do is we need to uh, divide the value of our cost of goods available for sale for cost of goods sold and your ending inventory. So after natin siyang i-project sa sales, hahatiin na natin siya sa cost of goods sold at saka ending inventory. That's how your gross profit method. But normally, it will only revolve as to our gross profit rate that will be used to estimate our cost of goods sold. Gross profit rate to estimate our cost of goods sold. While your retail inventory method is used for retail businesses, So what is the relationship that we look here in your retail businesses? This is the cost relationship. So we call it your cost ratio. Here, we call it your gross profit ratio. So the relationship that we look, or the ratio that is important in our gross profit method is the gross profit ratio. While for the retail inventory, the important is the cost ratio. Why? How do we use your retail inventory? So normally in a retail inventory, we have this cost and then we have your suggested retail price. So this retail price is the RP or SRP or the retail value. So retail value. Normally, this retail value should be known as your sales. This is known to be your sales. Now, instead of getting first the gross profit, kasi sa gross profit method, ang ginagawa natin, kunin muna natin yung sales, kunin natin yung cost of goods sold to get for the gross profit. Dito, hindi na natin siya idediretso on your gross profit. Kukunin agad natin yung ating cost ratio. Kukunin agad natin yung cost ratio. And then, we project that cost ratio based on your total SRP. Based on your total SRP. So, anong gagawin natin? Yung total SRP natin, hahatiin natin yan. Ang tawag natin dyan is sold, meaning that is the amount of the inventory sold at retail price. So amount of inventory sold at retail price. And then we get for the portion of unsold. Normally, you can read this in your textbook as the ending inventory at retail. Ending inventory at retail. So based on your cost ratio, we project it to your total SRP to compute for our sold. The sold multiplied by your cost ratio will give you your cost of goods sold. And your unsold or your ending inventory at retail multiplied by your cost ratio will give you your ending inventory at cost. Okay, so again, let's look as to the difference. On your gross profit method, what do we project first? We project the gross profit rate. So in your gross profit method, normally it is composed of these steps. First, we compute for your GPR. And then out of your GPR, we get for your cost of goods sold. And then we divide the value of our total cost of goods available for sale for your cost of goods sold and your ending inventory. Okay, gross profit method. How about your retail inventory method? So retail inventory method, what we do here is first we compute for your cost ratio. And based on your cost ratio, we can already divide the value of your total SRP as to your sold and unsold. And we just multiply it to your cost ratio to get for your cost of goods sold and for your ending inventory at cost. Ultimately, what we do is you're getting the value of your cost of goods sold and ending inventory at cost. Your gross profit method is used for the two purposes. That is to estimate the value of both the cost of goods sold and ending inventory, and also to estimate any loss. While your retail inventory method is normally used only for the first purpose, and that is to estimate the amount of your cost of goods sold and your ending inventory. Rarely do you see a retail inventory method wherein you compute for the amount of the loss. Rarely do you see a retail inventory method that you compute for the amount of the loss. It is always under your gross profit method. So the two purposes, we use it for your GPM, gross profit method, while the first purpose is used for your retail inventory method. Again, what is the difference? For your retail inventory, it is used in your retail business, and we look as to the relationship of your cost ratio over the retail price. While for your gross profit method, we get for a gross profit rate based on the entity's past experience, and we project that to your sales to get for your cost of goods sold and ultimately your ending inventory. But again, what is the main purpose? Your total cost of goods available for sale should be split up into your cost of goods sold and ending inventory. Should be split up in your cost of goods sold and ending inventory. Okay, so that's it for our two methods of inventory estimation. So we start now in our inventory estimation, and we start with your gross profit method. We start with gross profit method. Okay, so we already have an idea on what is the gross profit method. Now, what's important in your gross profit method is to estimate your gross profit rate. To estimate your gross profit rate. After that, we compute for your cost of goods sold. How do we compute for your cost of goods sold again? That is equal to your sales multiplied by 1 less gross profit rate. Sales multiplied by 1 less gross profit rate. Okay, so first we estimate your gross profit rate. So how do we compute for your gross profit rate? Your gross profit rate should always be based on sales. Your gross profit rate should always be based on sales. Meaning, guys, to compute for your GPR, you must always have the basis on your sales. You must have the basis on your sales. So how do we compute this one? This is equal to your gross profit or gross margin divided by your net sales to get for your gross profit rate, One thing is for sure, you cannot make use of your gross profit method without computing for your gross profit rate. So your gross profit rate must always be computed. So how do we compute it? Gross profit over your sales to get for your gross profit rate. And take note, it is always on sales. So your problems on your inventory estimation normally first gives you the amount of your gross profit rate. Gives you the amount of your gross profit rate, therefore no problem. But if ever what is given is the gross profit rate based on cost, what do we do? If the given is a gross profit rate based on cost, you need to convert it into a gross profit rate based on sales. Gross profit rate based on sales. So how do we convert a gross profit rate based on cost to your gross profit rate based on sales? So what do we do is we get for the value of your gross profit rate based on cost divided by your gross profit rate based on cost plus 100% to get for your gross profit rate based on sales. Okay, so let's illustrate the difference between a gross profit rate based on cost and a gross profit rate based on sales. So we have here based on sales and based on cost. So how do we compute? We have your sales less cost of goods sold to compute for our gross profit. So let's say we will have a both gross profit of 40%. We will both have a gross profit of 40%, but the one gross profit is for sales, another is for cost. Okay, so what is the basis of your sales? Gross profit rate based on sales is the sales. So take note, guys, whatever is the basis is the 100%. So this is 100%, 100%. Okay. So, sir, why did we place the 100% on your sales in your gross profit rate based on sales? Because again, the basis here is the sale. How about your gross profit rate based on cost? Sir, why did we place it in your cost of goods sold? Because here, our basis is the cost. So kung ano yung basis, yun yung may 100%. So kung kukunin natin yung gross profit based on sales, ang mangyayari, 100 yung sales, yung gross profit mo ay 40, ano yung cost of goods sold mo? 60%. Pero kung ito, based on cost, kung ang cost of goods sold mo ay 100, ang gross profit mo ay 40%, ano naman yung kukunin natin? Yung sales. So magkano yung sales? 140%. So to convert this based on cost to gross profit based on sales, what we do is we get for the gross profit rate based on cost. So 40% divided by 100 plus gross profit rate based on cost. Gross profit rate based on cost plus 100%, so 140%. So ayan siya, 40 over 140. We will get a value equal to, please compute guys, what is it? 40 over 140. I don't have my calculator with me. Wait. 40 over 140.
28.57 po.
Okay, 28.57. Thank you. 28.57%. So, ano yung ginawa natin? Kinonvert natin siya sa based on sales. So, kung makikita nyo, 40% divided by the sales pa rin siya. So, para to convert it, ang gagawin natin, gross profit rate based on cost divided by gross profit rate based on cost plus 100% to get for the gross profit rate based on sales. Okay? Clear tayo dyan, ha? Your gross profit rate must always be based on sales. So, problem will either give you the gross profit rate based on sales, no problem. If the problem will give you a gross profit rate based on cost, you convert it to your gross profit rate based on sales. Another is, number 3, the problem will give you a gross profit rate based on average performance, So how do we compute for this average performance? This is equal to your total gross profit divided by your total sales. So for example, guys, you have your year 1, year 2, year 3, year 4. So you are to estimate year 5. So here are the given sales and cost of goods sold. We have here your gross profit. So let's say 1,300,000. So this is 700,000. 2.2 million. This is 1,750,000. So this will give us 450,000. Year 3, we have 1.5 million. And then we have here 750,000. So 750,000. Year 4, we have 1.2 million. And then we have 600,000. So 600,000 ang ating gross profit. So pag ang sinabi is gross profit rate based on average performance. Tapos sabi niya, based on all the years. So, ang kukunin mo ay year 1, year 2, year 3. So, example natin, all years of operation. So, kukunin mo lahat yan. So, what is our total? Year 1, year 2, year 3, and year 4. So, ito total mo yan. 700 plus 450 plus 750 plus 600,000 divided by our total sales. We have 1 million plus 2.2 million plus 1.5 million plus 1.2 million. So how much? So this will give us 1.2 plus 600, 1.2 plus 1.3, 2.5 million divided by how much? 2.5, 4.7, 5.9. Tama ba? 2.5 divided by 5.9 million. So what is our rate? 2.5 divided by 5.9 will give us a rate of 42.37%. So yan yung ating gross profit rate. If ever sabi niya, based on average performance. Paano naman kung example natin is based on the past 3 years? Past 3 years. So kung past 3 years lang yan, kung year 5 ngayon, kunin mo yung past 3 year. Year 1, year 2, year 3. So kukunin mo lang yung hanggang year 2. So paano yung gagawin natin dyan? E di 450 plus 750 plus 600 divided by 2.2 plus 1.5 plus 1.2 million. So how much is this one? We have 1.8, I think. 1.8. 1.8 million divided by 4.9 million. 1.8 divided by 4.9 million. So 1.8 divided by 4.9 is 36.73%. 36.73%. So our rate now is 36.73%. So pagka ganyan yung given ng problem, sabi niya, GPR based on average performance, sundan niyo kung anong average performance yung gusto niyong kunin niyo. Is it all of the previous years or a certain period lang? Okay, that's another GPR. So another chance na ma-meet nyo for your GPR is the GPR is increase or decrease. Increase or decrease. So for example, the GPR this year is 5% more than the previous year. Tapos nakalagay previous year GPR is 20%. So what is the GPR this year? So GPR this year is 5% more than. So 20% plus 5%. Okay, ingat kayo ah. Basta lagi ang tatandaan ninyo, ang kukunin yung GPR ay based on sales. Ang kukunin yung GPR ay based on sales. So that is for our GPR. Okay, so how do we compute for GPR? Gross profit divided by sales, that is your GPR. But normally, it is either given by the problem or the GPR is based on cost, so we need to convert it, or the GPR is based on average performance, so we need to compute, or the GPR is either an increase or decrease of a previous year GPR or a GPR given. So what we do is we just affect the increase or decrease on the GPR to compute for our gross profit rate. To compute for our gross profit rate. Okay, we go now to our cost of goods sold. So how do we compute for your cost of goods sold? That is equal to sales multiplied by 1 less GPR. Actually, guys, 1 plus GPR is known as your cost ratio. 1 plus GPR is known as your cost ratio. But I do not want kasi na humaba yung process natin sa gross profit method. So, idediretso na lang natin siya. Actually, compute for GPR, compute for cost ratio, project the cost ratio to the sales to compute for your cost of goods sold. Project the cost of goods sold to your total cost of goods available for sale to compute for your ending inventory. So, ganun dapat. Kaso para hindi humaba yung process natin, and normally hindi naman tinatanong kung ano yung cost ratio, diretsohin na lang natin. Basta alam natin, guys, yung 1 less GPR is known as your cost ratio. 1 less the GPR is known as your cost ratio. Now, how do we compute for your sales? When we talk about sales, we talk about net sales here in this formula. When we talk about sales, we talk about net sales here in our formula. And net sales here is equal to your sales less sales return. Sales less sales return. So as you can see, we disregard allowances and we disregard any discount. So we disregard allowances, we disregard any discount. So what we made here, guys, here, we only deduct the sales return. So sir, why is it that we only deduct sales return and we do not deduct allowances or discount? We do not deduct allowances or discount because, guys, there was no actual return or there is no change as to our inventory. So take note, we are estimating inventory based on sales. So since we project it based on your sales, we look only for sales amount that really represents the movement in our inventory. Okay, so we only look for your sales amount that represents movement in inventory. Again, sabi natin, based on your GPR, we project it on your sales to calculate for your cost of goods sold. And cost of goods sold is an item of your inventory. So to get for the proper item of your inventory as to your sales, we only get for the amount that represents movement in inventory, meaning there is an actual increase or decrease in your inventory. Of course, in every sale transaction, there is a decrease on your inventory. Take note. In every sale transaction, there is a decrease on your inventory. In every sale return transaction, there is an increase on your inventory. Why? Because of course, the actual inventory was returned to you. Next question. In a sales allowance, is there an increase or decrease in inventory? Not at all, because that is only an allowance. That is only an allowance. Therefore, there's no actual increase or decrease in your inventory, unlike your sales and sales return. That's why we disregard sales allowance. Next, your sales discount. Why do we disregard it in computing for your net sales? We disregard your discount in computing for your net sales to because there is again no movement in our inventory. There's no movement in your inventory. Why? Because in giving a discount, you will only decrease your AR. The effect of a discount is decrease on AR and decrease on your sales. There was no actually increase in your inventory. There's no inventory returned. There's no decrease in your inventory. At all, it will only affect your sales and AR, not the actual amount of your inventory. Therefore, in inventory estimation, we disregard allowances and discount by the reason that these particular allowances and discount does not represent actual movement in inventory, unlike your sales and sales return. Okay, so take note of this in computing for cost of goods sold. Sales here is equal to your net sales, which means sales less sales return. We disregard any allowances or discount. Okay, so after computing your cost of goods sold by that formula, we are now ready to estimate the value of our ending inventory based on our total cost of goods available for sale. So now we get for your cost of goods sold based on this item. So based on what is computed a while back, we get for your cost of goods sold. And then we get for your ending inventory. We get for your ending inventory. Okay, so let's have an example to apply our learning regarding the different steps on your gross profit method. I'll erase this one na. Okay, so example. So beginning inventory, 300,000. We have here your net purchases, 750,000. We have sales of 800,000. We have sales return of 80,000. Sales return of 80,000. And then we also have sales discount amounting to 120,000. Okay. So our gross profit ratio, let's say, is 25%. Our gross profit ratio is 25%. So first, compute for the amount of your ending inventory and cost of goods sold if the GPR is based on sales. And then another one is to compute for the amount of your ending inventory and cost of goods sold if the GPR is based on cost. Okay, so what if it is based on cost? How do we compute it? So let's answer first. Compute for the EI and your cost of goods sold if the GPR is based on sales. So since GPR is already given, we do not need to compute for your GPR. We directly get for your total cost of goods available for sale. So number one, total cost of goods available for sale. That is your beginning plus net purchases. So we have 1,050. And then we project it directly to your cost of goods sold and your ending inventory. So cost of goods sold to compute, we get for your net sales. Your net sales, sabi natin, sales less sales return lang. So 800,000 less 80,000. Multiplied by 1 less our gross profit rate of 25%. So we have here 720,000 multiplied by 75%. 720,000 multiplied by 75% will give us 540,000. Now our ending inventory therefore is 1,050,000 less 540,000. We have 510,000. 510,000. Okay? So, madali lang, di ba? We just, again, get first for a GPR. If the GPR is given, no problem. Okay? So, that's it for number one, if the GPR is based on sales. Let's proceed to number two. Our total cost of goods available for sale, again, is 1,050,000. Our total cost of goods available for sale is 1,050,000. So, here, we again get for our cost of goods sold and our ending inventory. So our cost of goods sold is equal to your net sales, which is 800,000 less 80,000 multiplied by 1 less we convert now our gross profit rate. So that is 25% all over 100% plus 25%. So we convert first our gross profit rate. So 25 over 125 is 20%. So we have here 80% cost ratio. So 720,000 multiplied by 80% will give us 576,000. 576,000. So our ending inventory therefore is 1,050,000 total cost of goods available for sale less 576,000. This will give us an amount equal to 474,000. 474,000. Okay? So here we estimated our total cost of goods available for sale as to the amount of cost of goods sold and ending inventory based on your gross profit rate, whether it is based on sales or based on cost. Whether it is based on sales or based on cost. Okay? So are we clear? Clear? Okay. So we are now given this following information as to our inventory and as to our sales. So let's estimate the ending inventory and the cost of goods sold, assuming the gross profit rate, assuming that the gross profit rate is equal to 40%. Gross profit rate is equal to 40%. So if our gross profit rate is 40%, let's again compute if ever it is based on cost, and based on sales. So based on sales and based on cost. So first we compute for your total cost of goods available for sale. So to compute for your total cost of goods available for sale, the same ba rin, di ba? Inventory beginning plus purchases plus freight in less discount less returns. So how much is our total inventory. So 250 plus 470 plus 18. 250 plus 470 plus 18 less 4 less 8 will give us 726,000. So 726,000 ang ating total amount of our cost of goods available for sale. So based on cost and based on sales. So now, if that is based on sales, how do we compute again? To compute for your cost of goods sold, that is equal to your net sales. Your net sales, that is equal to your sales less sales return. So 540,000 less 33,000 multiplied by 1 less the gross profit rate of 40%. So how much is our cost of goods sold? So we have here 540 less 33 multiplied by 60%. We have 304,200. Now, what is our amount of ending inventory? So that is 726,000 less 304,200. We have 421,800. 421,800. How about if ever it is based on cost? If that is based on cost, we again compute for your cost of goods sold and your ending inventory. To compute for your cost of goods sold, we just get for the net sales again, 540 less 33,000 multiplied by 1 less 40 all over 40 plus 100%. So we convert first. We have 40 over 140. That is 28.57 less 1 multiplied by 507,000. So we have 362,142.86. So we disregard the point na lang para mas madali. And then our ending inventory is equal to 726,000 less 362,142. So 726 less 362,142. We have 363,858. 363,858. Okay. So that's how we will estimate your inventory. That is the amount of our estimation on your ending inventory and cost of goods sold. So we're done with the first purpose, and that is to estimate your ending inventory based on your amount of cost of goods available for sale and get the cost of goods sold and ending inventory. We proceed now to our second purpose. What is the second purpose of your gross profit method? That is to estimate also the amount of your loss on inventory. So how do we get for this loss on inventory? We compare, guys, the amount of our ending inventory estimated to your ending inventory actual. Now, the problem is, how do we compute for your ending inventory actual? Ending inventory actual. So to compute for your ending inventory actual, it is equal to your ending inventory count or salvage value. Sir, why is it count or salvage value? Count because in case that is only due to earthquake, you can still count it as to the amount. But if it is through fire, let's say, you only estimate the salvage value kasi nga nasunog yung inventory. So kukunin mo na lang yung salvage value niya rather counting it. Next is you get for your inventories not included in count. Okay, inventories not included in count. So sir, what are these inventories not included in count? In short, guys, kasi you compute for your loss based on your count, right? But not at all na yung count mo, yun lang yung amount ng inventory mo because there are inventories not included in count. So what are these inventories not included in count? So for example, number 1, we have your inventory out on consignment. So what is this inventory out on consignment, guys? So here, on your account, you did not include it. You did not include it. Why you did not include it? Because it is out on consignment. What do we mean again if ever it is inventory out on consignment? The inventory possession is not within the entity. It is with the consignee. It is with the consignee. So the inventory is not in our warehouse at the time of the circumstance. Whether the circumstance is a fire, an earthquake, or a stolen inventory, whatsoever circumstance, that particular inventory was not in our warehouse. Further, guys, it is not included in our account. Further, it is not included in our account. Since it is not included in our account and that inventory still exists, you need to add it. You need to add it in our account. Okay, so first one, inventory out on consignment. Why do we need to add it? Because it is not included in our account and that inventory still exists because it is outside in it still exists and it is outside our warehouse. It is outside of our warehouse. Another, inventory not included in count but still should be included in our account is your inventory in transit. Inventory in transit. So what are this inventory in transit? Either in transit to your buyer that hindi pa naman natatransfer yung ownership or in transit to us as a seller na nakasama na dun sa ating purchases. So take note, this particular inventory in transit must be included in our purchases or our total cost of goods available for sale before you include it. So for example, guys, you purchase an inventory amounting to 900,000 pesos. So you already included it in the purchases. However, when the fire broke out, what happened is that that particular inventory is still in transit. Question, is that inventory considered loss? No. That inventory is not considered loss. Why? Because actually, hindi naman siya naisama dun sa nasunog. Hindi siya naisama dun sa nasunog. Another question, at the time of your count, nandun na ba yung inventory na yon? Hindi pa, kasi nga, in transit pa lang siya. In transit pa lang siya. And since in transit siya, anong gagawin natin? Since in transit siya, kailangan nating idagdag yan kasi hindi siya nadagdag sa ating count. Sir, pwede ko bang tanggalin na siya dun sa total cost of goods available for sale instead? No. Kasi pag tatanggalin mo siya sa total cost of goods available for sale, magkakamali naman yung value ng iyong ending inventory. Magkakamali naman yung value ng iyong ending inventory. So inventory in transit, that is as to your purchases included in your total cost of goods available for sale. Another one, we have your other inventories. Other inventories. Not in the warehouse. So, naging general na to. Kasi pagka inisa-isa pa natin, baka hindi na natin malaman lahat ng possible scenarios. Ang normal scenarios kasi ng problem, it is out on consignment or it is in transit. Ano naman tong other inventories not in the warehouse? These are inventories included, not included in the count, but still an actual inventory. So what are these? For example, guys, you made your count in the warehouse, and there is an inventory awaiting for the instruction in the delivery department or the shipping department. So, meron ka palang inventory sa shipping department na wala sa warehouse. Nung gumawa ka ng count, ang na-count mo lang yung nasa warehouse. Therefore, guys, it is not included in your actual count. So, you need to adjust your actual count. You add the other inventories not in the warehouse. Okay. So what is our rule here in computing for your actual? It is equal to your cost or salvage value plus any other inventories not included in the count. So what are these inventories not included in the count? Example are inventory out on consignment, next inventory in transit, next other inventories not in the warehouse but still exist. And take note, before you include them as inventories not included in the count, there must be or they must be included first in your purchases Because if ever it is not included in your purchases, no need to also include it. No need to also include it. So take note, it must already included in our value of purchases, because again, what we split is the total cost of goods available for sale, which is composed of your beginning and your net purchases. So once it is included here in your net purchases, it must also be included in your actual count. So why again do we need to add inventories not included in the count? Because there are instances that the count is made in the warehouse and the inventory, some portion of it is not in the warehouse. So you need to add those portions not in the warehouse. Okay, so take note, you compare your ending inventory estimated versus your ending inventory actual. This is considered your loss inventory. This is considered your loss inventory. So your question, what now is our subsequent measurement of our inventory? What now is our subsequent measurement of inventory? Since meron naman kaming inventory estimated and inventory actual. Take note on your subsequent measurement of inventory, you use your lower of cost or net realizable value. What is this cost? This is the actual amount. What is the NRV? This is the salvage value. So either way, in short, on your subsequent measurement, how do we subsequently measure it? Is it on your estimated or actual? We use your ending inventory at actual. Ending inventory at actual. Clear? Okay. So let's try to have some examples on how do we compute for your ending inventory and cost of goods sold using the second purpose, wherein we compute first for the loss. So let's just have a recap on what is the process again. So based on your gross profit rate, you get for your total cost of goods available for sale, and then get for your cost of goods sold first, and then your ending inventory. Your ending inventory computed as estimated will be compared to your actual inventory, will be compared to your actual inventory. Okay, so let's have an example. So let's have here your beginning inventory amounting to 900,000. And purchases amounted to 1,360,000. Freight in 40,000. Purchase discount is 25,000. Purchase discount is 25,000. Sales is 1,858, 1,858,000. And our gross profit rate, we have here a 35% gross profit rate. 35% gross profit rate. Also, we have here sales discount amounting to 31,500. And there was a fire. And the actual inventory, not damaged, has a value of 170,000. And we have your damaged inventory at salvage value. Let's say it can be sold at 145,000. So how much is the loss? Okay, so here we already determined it is a loss because you are given the actual amount of your inventory plus any damaged inventory. So here, dalawa siya. Hindi lahat na damage, may na-damage, may hindi na-damage. So pagka ganito yung problem, kunin nyo yung total value niya, yung not damage at saka yung salvage. Sir, paano kung lahat damage yan, salvage lang? Kung walang damage, yung actual naman. Okay? So dito, ipag-add natin yung dalawa. So what is our actual inventory? Our actual inventory amounts to 170 plus 145, 315,000. It amounts to 315,000. So first, compute for your total cost of goods available for sale. So we have 900,000 plus 1,360,000 plus 40,000 freight in less purchase discount of 25,000. So let's get for the value. So we have 900,000 plus 1,360 or 1,360,000 plus 40,000 less 25,000 will give us 2,275,000. 2,275,000. And we get for the value of your cost of goods sold first. So our cost of goods sold is equal to 1858. We do not deduct the discount. We multiply it to 1 less the gross profit rate of 35%. So 1,858,000 multiplied by 65% will give us 1,207,700. So what is our ending inventory estimated? That is 2,275,000 less 1,207,700. We get for this value. So we have 1,067,300. So this is the estimated. We compare it to your actual. So our actual is 315,000. So less 315,000. We have 1,067,300 less 315,000. We have 752,300. This is the amount of our loss, 752,300. So what is the difference of this particular purpose as compared to your other purpose here? We need to compare it in your actual. And how do we compute for your actual? We have your count or salvage value, or pwede rin naman palang count plus salvage value plus any other inventory not included in the count. Okay? And we compare that with your estimated. The difference is the amount of your loss. Guys, our examples are straightforward. At some point, minsan, kailangan pa ninyo mag-compute ng total sales ninyo. So how do we compute for your total sales again? Your total sales is equal to your cash sales plus credit sales. So how do we compute for your credit sales, guys? Your credit sales is equal to your AR. So we have here beginning AR less collection. We have here your ending AR. We have here your credit sales. So in case, guys, hindi given yung credit sales, pero merong AR, pwede ninyong estimate yung credit sales. So ang either problem lang naman dyan is hindi pa given yung total amount ng sales. So kailangan natin kunin yon. Tapos, meron pang cash sales din. Meron pang cash sales din. Kaya yun yung mga kailangan nating tingnan din. Okay, so let's try to have an example wherein hindi given yung sale. Hindi given yung sale. So we have your beginning inventory amounting to 460,000. We have your beginning inventory amounting to 360,000. So here in our 460,000, and then we have your purchase amounting to, let's say, 1,390,000. Amounting to 1,390,000, and then we are given a cash sale of 215,000, and then we have your collections of, let's say, 2,005,000. We have your AR beginning of 165,000, AR ending of, let's say, 235,000. We have your salvage value of 15,000. We use a gross profit rate of 30%. So here, hindi na siya straightforward as to our sales. So what do? We compute your sales based on cash sales plus credit sales. So how much is your total sales? Sales is equal to your 215,000. And then we have your credit sales, which is equal to 2,005,000 plus 235,000 ending less beginning of 165,000. So we use this T account. So gagamitin natin yung T account. We have here your AR beginning amounting to 165,000. We have your AR ending 235,000 and collection of 2,005,000. Okay, so how much is our amount of sales? So 2,005,000 plus 235,000 less 165,000. our credit sales is 2,075,000. So after computing our credit sales, we add it to your cash sales of 215,000. So we have 2075 plus 215, we have 2,290,000. So after computing your sales, we can already get for the amount of our cost of goods sold and ending inventory. So what is the total cost of goods available for sale? We have 460 plus 1390. So this is 1,850,000. So 1,850,000. Hahatiin uli natin yan, guys, as to the amount of our cost of goods sold and our ending inventory. So cost of goods sold, we have your sales computed, 2,290,000. And then we multiply it to your 1 less gross profit rate. So how much? So 2,290 multiplied by 70%. So we have 1,603. 1,603. So our ending inventory is equal to 1,850,000 less 1,603,000. So 1,850,000 less 1,603, 1,850 less 1,603 will give us 247,000. And we compare this to your salvage value. So ending inventory estimated amounting to 247,000. And then we have your salvage value amounting to 15,000. So 247 less 15, we have 232,000. 232,000. Okay, so that is the amount of our loss. That is the amount of our loss. Clear? Okay, so in case, guys, that again, you are not given the amount of your sales, you are given the amount of your AR, we can compute for the amount of your sale as equal to your cash sale plus credit sale. And we compute for the total credit sales based on your T account of AR, based on the T account of AR. So we're done now talking about your gross profit method. We are now in your retail inventory method. So in your retail inventory method, this is another method of inventory estimation. Retail inventory method. Another method of inventory estimation. However, here, unlike in your gross profit method, wherein we look as to the relationship of your gross profit and project it to your sales, here we look as to the relationship of your cost to your retail. Cost to your retail. So cost to retail ratio. We call this one your cost ratio. So normally, you can say that this is a retail inventory method if the problem gives you a cost value and a retail value. Cost value and a retail value. So how do we compute now in your cost to retail ratio or cost ratio? So remember, guys, these steps that we have said a while back. First, we compute for your cost ratio. And out of your cost ratio, we get for your total cost of goods available for sale. We get for the sales multiplied by your cost ratio. This is your cost of goods sold. And then your ending inventory is equal to your EI at retail multiplied by your cost ratio. So this is your ending inventory. Now, therefore, our problem here is how do we compute for your cost ratio? How do we compute for your sales? And how do we compute for your ending inventory at retail? Okay, so these are the items that we need to learn here in your retail inventory method. So first, how do we compute for your cost ratio? How do we compute for your cost ratio? Your cost ratio depends on the method of your retail inventory. So it depends on the retail inventory method. So what are the three types or three methods for your cost ratio? First, we have your conventional. Another is we have your average. Next, we have your FIFO. conventional, average, and FIFO. So what are the differences of these three items? What are the differences of these three items? So actually, in your cost to retail ratio, we are more focused as to your retail. So on your retail, we have these different items. So what composes your total cost of goods available for sale at retail? So the following are the items of your cost of goods available for sale at retail. First, we have your beginning inventory, of course. We have your net purchases. We have your markup. We have your markdown, transportation in, and transportation out. Beginning inventory, no problem. You already know that one. That is the amount of our inventory at the start of the period. Next, net purchases. That is our total purchases, net of any returns, and add any discount. Next, we have your markup. Your markup is the amount of your increase on your standard selling price or your suggested retail price. So what is this markup? So initially, di ba, we have this cost. Initially, we have cost and then we have your retail. Your retail is your SRP. We said your retail is your SRP. If you increase your SRP, we call that one markup. Any increase or change in your SRP is known as markup. How about, sir, if that increase in markup or SRP is subsequently removed? We call it markup cancellation. We call it markup cancellation. And then we also have your markdown. What is this markdown? So we already have your SRP. That is your retail. So if your SRP is decreased, we call that one markdown. If your SRP is decreased, we call it markdown. Take note, guys, we look into the relationship of your cost to your retail price. What is that retail price again? Your SRP or your suggested retail price. So the relationship between cost to retail is known as your cost ratio. Now, under your cost ratio, we have three methods to estimate it. So it's either conventional, average, or FIFO. Now, under these cost ratios, what are the items inside it? So we look as to the items inside your total cost of goods available for sale at retail. These are your beginning inventory, net purchases, markup, markdown, transferred in, and transferred out. So we're done with markup and we're done with markdown. Markup, any subsequent increase to your suggested retail price. Markdown, any subsequent decrease on your suggested retail price. Next, we have your transferred in. What is this transferred in? That is the portion of inventory transferred to our department. So any inventory that is transferred to our inventory is called transferred in. So you already know this one. TN in your work in process, especially with your process costing. Transferred out, any inventory flowed out from our department. So going into our department, to our department, transferred in. From our department, transferred out. So of course, net purchases are all included on these three items. So we have your net purchases for average, conventional, and FIFO. Transferred in and transferred out are included also in the computation. How about beginning inventory? For beginning inventory, only conventional and average. You do not include beginning inventory for your FIFO. Markup and markdown are both included for your average and FIFO. However, markup is only included for your conventional but not markdown. Sobrang dami, di ba? So normally, ganyan mag-present yung ating mga libro. Ganyan mag-present yung ating mga libro. But I don't want you to memorize it that way kasi sobrang dami ninyong i-memorize pagka. So what I want you is to first know how to compute for your cost ratio rather than knowing all of these items. So here in your cost ratio, we first decided to show the items inside the total cost of goods available for sale under conventional, average, and FIFO. And that is the three methods. However, guys, in our standard now, past 2, it is provided that inventory should only be measured using average or FIFO. Average or FIFO. Wala nang conventional. That's why we should not learn about conventional already. Ang focus na lang dapat natin ay average at saka FIFO. Average at saka FIFO. So how do we compute for your average and FIFO? So to compute for your average cost ratio, average cost ratio. Average cost ratio is equal to your total cost of goods available for sale at cost divided by your total cost of goods available for sale at retail. And then for your FIFO cost ratio, we just get for the total cost of goods available for sale at cost less beginning inventory at cost divided by the total cost of goods available for sale at retail less beginning inventory at retail. Less beginning inventory at retail. So first, this is the first step. Compute for your cost ratio. So remember this one first. How to compute for your cost ratio? Either average cost ratio or FIFO cost ratio. Next, number 2. We compute for your total cost of goods available for sale, both at cost and at retail. So what are the items of your cost of goods available for sale? So first, of course, we have your beginning inventory. We have your purchases. We have your purchase return, purchase discount, and allowance. Freight in. We also have your additional markup. Markup cancellation. Additional markdown. Markdown cancellation. Additional markup cancellation, additional markdown cancellation, and then we have your T-in, and then we have your T-out. So transferred in and transferred out. So of course, beginning inventory is both included on the items. Your purchases are both included in the items. Purchase return is a reduction on the items. Take note, guys, purchase return, there is an actual increase or decrease in your inventory. So in the case of purchase return, there is an actual decrease. Purchase discount is used in your at cost, but not on retail. Sir, why do we not make use of your purchase discount or allowance under your retail? You do not make use of your purchase discount or allowance under retail because, guys, there is no actual decrease in your inventory. So take note, our rule a while back, we only affect items that has an actual decrease or increase in the inventory or a movement in our inventory. A discount or allowance does not increase or decrease our inventory. Next, how about our freight in? How do we affect your freight in? How do we affect your freight in? We only add it to your purchases at cost. Do not add it on your retail. Same reason, same reasoning. Why we do not add it on your retail? Because a freight in does not increase the amount of our inventory. In short, guys, there is no actual change as to the count of inventory. Hindi ibig sabihin na nagka-freight in tayo, madadagdagan yung 500 units ng inventory natin ng ilang units pa. It will remain as 500 units. So there is no actual movement in our inventory in a freight in. So do not affect it in your retail. Now for your markup, of course, that pertains only to your retail. Markup is an addition to your retail price. Therefore, we add it. Markup cancellation is a subsequent cancellation of the addition on the selling price or the SRP. So we decrease it. Markdown, that is a decrease on your selling price. So we remove it. Markdown cancellation, guys, is a subsequent cancellation of the markdown. Therefore, if it is initially a decrease, once you cancel it, it will increase our retail. Transferred in, any inventory transferred to our department. So both include. Transferred out, any transferred or any transfer of inventory from our department. So from our department out, so we remove this one. After that, we can already compute for your total cost of goods available for sale at cost and at retail. Take note guys, the differences of these items. Okay. So kung saan lang sila preso. So here, purchase discount, allowance, and freight in is only applicable to cost. Purchase, additional markup cancellation, markdown cancellation, you place it at your retail. Guys, para hindi kayo mapakaraming iisipin na items dyan, kunin nyo na lang yung net markup at net markdown. So what is that? That is additional less cancellation. Additional less cancellation. Pag markup yan, add. Pag markdown yan, deduct. Paano mag-compute? Additional less cancellation. So the additional of markup less cancellation of that markup is net markup. Net markdown is the additional of that markdown or a cancellation of that markdown. And the effect of a net markdown is decrease. Okay, so look at these items that is different in our computation of our total cost of goods available for sale. For at cost, purchase discount and allowance, and freight in. At retail, the net markup and the net markdown. After we compute for your total cost of goods available for sale, what we do is the total cost of goods available for sale will be split as to your sales and your ending inventory at retail. So first, how do we compute for your sales? How do you compute for your sales? To compute for your sales, sales is computed as follows. Sales is computed as follows. Sales is equal to sales less sales return. You already know the reason why we deduct sales return, but we ignore any allowance or discount plus normal loss. Sir, why do we treat your normal loss as addition to your sales? Diba, nasabi natin kasi kanina, yung sales na mako-compute nyo multiplied by the cost ratio is equal to your cost of goods sold. And your loss is either normal or abnormal. A normal loss is an item of cost of goods sold. An abnormal loss is an item of our operating expenses. So therefore, to include in our cost of goods sold the normal loss, we add it to your sales. Okay? To include it in our cost of goods sold, the normal loss, we add it to your sales. So in case guys, you are given a normal loss, whatever type of loss is that, so long as it is normal, add it to your sales. Plus employee discount. Sir, how about an employee discount? What is this discount? Guys, this employee discount normally happens in case of a purchase of your employees and they are given a discount percentage that is only specific to them. If you do not add that employee discount on your sales, it means that this sales kasi guys is net of employee discount. It is net of employee discount. So since it is net of employee discount, what we have here is it is not already at SRP. It is not already at SRP. So why is it not at SRP? Because guys, the discount is only specific to employees, not to all persons. Since it is not to all persons, we need to add it back. Sir, how about a discount to some persons? Guys, the discount on some persons are already known as your markdown. Alam mo yung mga sale. Halimbawa, pumunta kayo ng SM, nakalagay 50% sale, 30% sale. That is applicable to all, right? We call that markdown. So that is already the amount of the discount applicable to all. So dati na natin yung na-effect dun sa ating formula. dati na nating na-effect. Another reason why a sales discount is not deducted to your sales already because actually it was already in your markdown or your markup. Clear? However, guys, here in your employee discount, it is not applicable to all. It is only for your employees, and your sales here is initially recorded net of employee discount. Therefore, since that is not uniform to all, it will distort our percentage. It will distort our percentage. Then we need to add it back. Okay? So this is now your net sales. This is now your net sales. How about your ending inventory at retail? How do we compute for your ending inventory at retail? Your ending inventory at retail is equal to your total cost of goods available for sale at retail less net sales we computed. This is your ending inventory at retail. This is your ending inventory at retail. Guys, I have a call. I'll just answer this one. Wait. After we get for the amount of your sales and your ending inventory at retail, we multiply these amounts to your cost ratio to get for your cost of goods sold and your ending inventory. The amount of your cost ratio depends whether, guys, it is FIFO or average, as we have discussed a while back. So, ayan, our cost ratio depends whether it is FIFO or average. So, instead of looking as to the items na lang, ang gagawin muna natin, total cost of goods available for sale, we compute for the cost ratio, and then we compute for your net sales, and then ending inventory at retail. So, it is quite procedural. It is quite procedural. So, to know whether how to apply this, let's have an example. Let's have an example for us to properly apply it. So have your costs and we have here retail. Beginning inventory, we have your net purchases. And then we have your net markup. We have your net markdown. We have your sales return, employee discount, sales discount, normal loss. Okay, so let's provide for values. This is 820,000. This is 2,280,000. For retail, 1,262,000. And then we have 3,607,200. And 450,000, 320,000. And then 4,350,000, 300,000. Employee discount of 100,000, sales discount of 80,000, and then normal shrinkage of 50,000. Okay, so ito yung mga values natin. Ayan, lipat lang natin para mas malapit siya. Ayan. So we are now given the values. So our first step, we compute for your total cost of goods available for sale at cost and at retail. Okay, so we have here beginning inventory, 820,000 and 1,262,000. We have your net purchases of 2,280,000 and 3,607,200. We have your net markup of 450,000 and net markdown of 320,000. After that, we can already compute for your total cost of goods available for sale. So how much is the total cost of goods available for sale at cost? So we have 820,000 plus 2,280,000. So 820 plus 2,228,000 is 3.1 million. For retail, we have 1,262,000 plus 3,607,200 plus 450,000 plus 320,000. We have 4,999,200. Okay. After we compute for your total cost of goods available for sale, we can now compute for our cost ratio. So our cost ratio depends whether the method is average or FIFO. For average, we just compute for the total cost of goods available for cost, and we divide it to your retail total cost of goods available for sale. So ganun lang kadali. So 3.1 million divided by 4,999,200, we have here 62%. For your FIFO naman, ang gagawin naman natin is from your 3.1 million at cost, ibawas natin yung beginning na 820,000. Ibawas yung beginning na 820,000. Tapos yung nasa divisor niya, divisor ba? I don't know what you call it. So we have 4,999,200 less 1,262,000. 1,262,000. So let's compute. So 3.1 million less 820,000 divided by 4,999,200 less 1,262. We have here a percentage equal to 61%. A percentage equal to 61%. Okay, so we're done computing for your average and your FIFO cost ratio. The next step that we need to do is to compute for our net sales. So how do we compute for your net sales again? We have your sales less sales return plus normal loss plus employee discount. So our sales amounted to 4,350,000. Our sales return is equal to 300,000. Our normal loss is equal to 50,000. And our employee discount is equal to 100,000. So how much is our net sales? So 4.35 million less 300,000 plus 50,000 plus 100,000 will give us 4.2 million. 4.2 million. Now, after that, we are ready to separate the total cost of goods available for sale at retail. So how much is our total cost of goods available for sale at retail? We have 4,999,200. 4,999,200. So if our total cost of goods available for sale is 4,999,200, so our sales is 4.2 million. Our ending inventory at retail is equal to, again, it is equal to 4,999,200 or total cost of goods available at retail less the sales of 4.2. So this will give us 799,200. You multiply it to your cost ratio. You multiply it to your cost ratio, then we can compute now for your cost of goods sold and ending inventory. So let's use first your average. Let's use first your average. How much is the cost of goods sold and how much is your ending inventory? So for your cost of goods sold, we compute for your sales, 4.2 million, multiplied by your cost ratio for average, which is 62%. And then for your ending inventory, we have 799,200 multiplied by 62%. So let's compute 4.2 million times 0.62 is 2,604,000. For your ending inventory, we have 799,200 times 0.62. We have 495,504. So let's get the total plus 2,604. This will give us 3,099,504. 3,099,504 or approximately 3.1 million. So, sir, bakit hindi siya nag-equal? That is due to rounding. Or kung gusto niyo naman, pwedeng ang gawin niyo is, another way on how to compute for your cost of goods sold. So, cost of goods sold is equal to 4.2 million times 62%. Tama? So, 2,604. Kung gusto niyo na saktong-sakto siya, yung ending inventory nyo, ang pag-compute nyo naman is equal to your total cost of goods available for sale at cost less cost of goods sold. So how much is our total cost of goods available for sale at cost? 3.1 million, di ba? So 3.1 million yan. I-deduct mo ngayon yung na-compute mo sa cost of goods sold na 2,604. So 3.1 million less 2,604 will give us 496,000. So it's almost the same. Yun nga lang kasi guys, nag-round kasi tayo. Nag-round kasi tayo. Okay? So what is the process? We go back. First, we compute for your total cost of goods available for sale. So this is the first process. Computation of your total cost of goods available for sale. We compute both for cost and retail. And then we compute for your cost ratio, whether average or FIFO. And then we compute for your net sales. How do we compute for your net sales? Sales less sales return plus net loss plus normal loss plus employee discount. And then we now separate the amount of our total cost of goods available for sale at retail for your sales at ending inventory at retail. So how do we get that? So after computing your sales, from your total cost of goods available for sale at retail, we deduct the amount of our sales. That is the ending inventory at retail. And then we multiply it only on our cost ratio depending on the method. So if that is average, we use 62%. Okay, we use 62%. How about guys, if we use FIFO? If we use FIFO, so we have here our COGS. We have our sales at 4.2 million multiplied by our cost ratio at FIFO, 61%. So 4.2 times 61% will give us 2,562,000. 2,562,000. And then we get for the value of our ending inventory this way. Hindi na applicable yung multiply to cost ratio sa FIFO. Ang gagawin nyo na lang talaga is idediretso na siya. So meron tayong 3.1 million less 2,562,000. Makukuha nyo agad yan. 3.1 less 2,562, we have 538,000. Sir, paano kung gusto naman namin yung cost ratio ang gagamitin ninyo? So kung gusto nyo yung cost ratio, ang gagawin natin is your ending inventory at retail multiplied by the cost ratio plus beginning inventory. Okay, so try natin guys. No, that's for cost of goods sold, I think. Yes, that's for cost of goods sold. Kasi hindi na natin mahahati yon. So ang gagawin natin is yung sales multiplied by your cost ratio plus beginning inventory. So our sales amounted to 4.2 million multiplied by cost ratio of 61% plus beginning inventory. Our beginning inventory is 820,000. 820,000. So how much? So 4.2 million less multiplied by your cost ratio. So we have here 61%, but parang nalilito ako. 4.2 times 61% is 2,562. I don't think that we will compute it by adding 820. Wait, guys. Let's compute first for your ending inventory. Mas nalito ako doon na how much is our ending inventory at retail? That is equal to 799,200, right? Multiplied by 61%. 799,200 times 61% is 487,512. So to compute for your cost of goods sold, we get the total amount, which is 3.1 million, less 487,512. Less 487,512. So 3.1 million less 487,512 is equal to 2,612,488. Tama na ba? Yeah. So in your FIFO, what we do first is to compute for EI. And next we compute for cost of goods sold. So sir, why do we not multiply it directly on our percentage? Due to the amount of our beginning inventory. So due to the amount of our beginning inventory. Actually here in our cost of goods sold, if you want to really compute it, so we have 999,200, right? Less 1,262. So how much is our total cost of goods available for sale? Wait, total cost of goods available for sale at retail. So we have 4,999, 200 less 1,262. Sir, ano yung 1,262? Yan yung beginning inventory at retail. So 3,737,200 yan. Tama? You multiply it to 61%, which is the cost ratio, times 61%. We have 2,279,692 plus your beginning cost So how much is our beginning cost of inventory? So our beginning cost of inventory is equal to, ano ba yan? Nalito talaga ako. Wait. Erase. Ulitin natin. So ang gagawin mo dito is sales less beginning inventory. Sales less beginning inventory multiplied by your cost ratio plus, ano na yung plus natin dito? Yung beginning inventory at cost. Okay, itry natin. Sana magtama na tayo para tayo nag-trial and error. 4.2 million less beginning inventory. So how much our beginning inventory at retail? Balik tayo dito. Our beginning inventory at retail is 1,262. So ibawas natin yung 1,262. Multiplied by 61%. How much? So 4.2 million less 1,262 times 0.61 will give us 179,180 plus our beginning inventory at cost. How much is our beginning inventory at cost? Balik tayo dito. Our beginning inventory at cost is 820,000. 820,000. So how much? 179,180 plus 820,000 will give us 2,612,180 or almost the same here. Okay? So ayan. Finally, nakuha na natin siya. So under FIFO, guys, again, first we compute for EI. So how do we compute for your EI? So ending inventory at retail multiplied by your cost ratio. And then next, we compute for cost of goods sold. So we just compute for your total cost of goods available for sale less your ending inventory at cost. So this is our cost of goods sold. So mas madali yung formula na to rather than this formula kasi mas nakakalito siya. Sir, bakit natin tinatanggal yung beginning inventory at ina-add uli siya? Kasi doon sa ating formula dito, tignan nyo, nagbabawas kasi tayo ng beginning inventory. So binawas natin doon sa ratio yung beginning inventory at retail. So kailangan natin siyang ibawas doon sa ating sales. And then, i-add natin yung beginning inventory at cost. Okay? So I hope gamitin nyo na lang kung ano yung mas madali para sa inyo. I think this is the best for FIFO. Compute for EI and compute for cost of goods sold. It is rather easy as compared to the other formula. Okay, so we just split it na lang by first computing the EI. Okay, questions before we end our class?